Hello, all. Josh Pick, and today we cover an important question that we hear all the time. We've heard it a million different ways, and that is, does it make sense to work with a financial planner? Or more importantly, am I better off simply putting my money in index funds? Because we've heard all the old adages, right? 95% of mutual fund managers don't beat the respective benchmark, etc. So in today's video, I'm going to give you 3 reasons why working with a financial planner would make sense, or working with a fiduciary would make sense. Now, I have to give a disclaimer before we get into those 3, and that is not all financial planners are created equal. So if you're listening to this saying, well, the ones that I've worked with haven't done that, well, that's probably therein the problem. So find a true fiduciary financial planner, and you can get all of the things that I'm about to talk about. So, number 1, asset allocation and financial planning. This is as simple as saying coupling your goals with how you're actually investing. And this may seem very obvious to many of you, and you may be thinking, well, I could do that on my own. And that might be true. But all too often, we see folks that come in our office whose asset allocation, the rebalancing strategy, where their money is simply invested, does not match up with their goals or their ability to tolerate volatility and risk. So all too often, we will meet with people that say, I'm a moderate investor. That's why I put my money where it is. And when you look at it, they look like an aggressive growth investor, or vice versa. Now, there's been a lot of studies done by companies like Envestnet and other top 10, largest money managers in the world, trying to correlate what percentage value are all of these items that I'm about to talk about worth. And they estimate that just simply doing proper financial planning, allocating your money in the right places, and then rebalancing those as you go through the seasons of life is worth upwards of almost 1% as a rate of return per year. So pretty significant. And then the second reason is simply fund selection. And you could say fund selection correlates to, what stocks you pick, which mutual funds you pick, what ETFs you pick, what separately managed accounts you pick, or what annuities you pick. All of these different items, there are different levels to this game, right? And on one hand, you'll have the fund managers who absolutely don't beat their respective index, but then you'll have the ones that absolutely trounce their respective indexes at potentially even less risk. Now, is that worthwhile? Well, it can be worth a tremendous amount. As a matter of fact, the fund selection piece, through all of the research that we've seen, is arguably one of the biggest pieces. And not to put the cart before the horse, but the estimates from companies like Capital Bank and Trust or American Funds, Envestnet, they all say that appropriate financial planning, fund selection, risk mitigation, tax preparation, all the things that you can do as a financial planner is worth upwards of 3% a year. And in the first 2 examples I gave you, we're almost up to 2%. The third being taxes. Now, taxes is a delicate topic to discuss, because I'm sure you've talked to many financial planners or investment managers or wealth managers or whatever they're calling themselves, and they say, we don't give tax advice. We can't give tax advice. And to a large percentage of planners, that's true. Not here. Will we give tax recommendations, advice, and try and create strategies that will mitigate taxes? Yes. Are taxes saved equivalent to interest earned? Sometimes it's even more valuable than that. For example, if you could put yourself in a scenario where maybe you have a level 5 risk, let's say, on a scale of 1 to 10, and you're getting a 5 rate of return, but that rate of return is tax-free, is that not as good as upping your risk and paying more in taxes to achieve the same result? So again, not only is taxes saved equivalent to interest earned, it can also be equivalent to interest earned at a lower risk tolerance. This is a big one that I think is overlooked. It is important that in any financial plan, as of today, you're taking into account taxes. I have yet to meet a client that is not concerned about taxes going up rather than down. We hear conversations about the deficit, the budget issues that we have as a country, and the belief is that taxes will go up over time. So you want to put yourself in the most tax advantaged position possible. So again, 3 reasons that undoubtedly make sense to work with a financial professional, and why managed accounts can outperform their respective indices, is appropriate asset allocation in relation to your goals and rebalancing those over time with the seasons of your life. Proper fund and management selection can make a significant difference. And then the third is tax mitigation or minimizing the impact of taxes on your portfolio. Now, I know in this video I'm ignoring a lot of things like overall risk mitigation, helping people emotionally cope with the stresses of the market so they don't make bad decisions, making sure you earn as much on your cash as you can through appropriate bank instruments. There's a myriad of examples where an all-encompassing proper wealth management makes a dramatic difference. And we're going to cover those in subsequent videos individually. So the first three that we talked about, we'll talk about more in depth and how you achieve those, and then many of the other things that you can do to improve your situation and why it makes sense to work with a financial professional to achieve your goals. If you like this video, please click the subscribe or like button below, and don't forget to check out the videos that I just talked about.